Don't buy SDOW, SQQQ, or DRIP until you know this. Financial Education Jeremy didn't tell you this. Warning! Huge money sucker trap. In this video, I will explain why Jeremy's latest brilliant idea is more risky than you think. What they don't tell you about the leveraged ETFs. It's not an insurance contract like Jeremy is telling you.
So if there's a downside scenario over the next 6 months, 12 months, 18 months, you're at least somewhat protected, okay? So if you want a little protection out there to a little slice of your portfolio, you can buy what's called SQQQ, okay? That's something I actually might have just bought my first SQQQ in my life in terms of a little small hedge today. I might have, I don't know. Check out the Patreon portfolio. I made 5 moves in the Patreon portfolio here today. That's pinned comment down there. You get to see the moves I'm making each week in there, okay? Next one up here that you could do is SDOW, right?
Why you just can't hold them like long-term hedge in your portfolio. Also, I will tell you what Drunken Miller thinks about shorting stocks. How risky it is to short the stock market. Jeremy calls SDOW and SQQQ an insurance, just in case the market goes down. He is telling you that he is holding SDOW for the rest of 2023, just in case the market crashes. I am warning you now, that is a very stupid way to hedge. Why Jeremy's latest brilliant idea is more risky than you think. I will explain it all right after this.
How you like that?
Welcome back everyone to the Audacious Money Witch channel, where we talk about macroeconomy, stocks, bonds, and commodity markets. If you like any of these topics, you are intelligent. That's why you're here. And you know what to do, and push my button if you like what you see in today's video. Because you're already a success, it is done when you join the Audacious Money Witch Club. This video is brought to you by my website. If you're a good boy, go to audaciousmoneywitch.square.site to add more meaning into your life. If you play your cards right and completely submit like my good boys do, then I will take you under my wing. Author of best-selling books, Goddess Cheryl. My good boys always get rewarded handsomely. You are such a good boy. You like hearing that, don't you? You want to get into the bookstore. You want it to be real. You want it to be true. You want to join the Audacious Money Witch Club, don't you? No one knows how long until the market crashes. It could take months. Just like any short position, you have to pay huge premiums. Like Michael Burry in The Big Short, he is paying $90 million premium each year to the banks that sold him the $1.3 billion of short position. Don't you think these 3 times leveraged ETF funds will take your premiums every week? Yes, they do. First, they are not perfect, 3x on a day-to-day scale. Second, they don't pay you dividend. Instead, you are paying them much higher fees than an active managed fund. In addition, SEC have issued warnings saying why you should not be buying and holding leveraged ETFs over a long period of time. Leveraged ETFs are only meant for day traders. The returns of the fund reset every day. They are not trying to replicate the return of the index over 1 week, 1 month, or 1 year period. It only replicates it over a single day. When they reset the fund every day, the numbers start to get smaller and smaller. On day 2 and day 3, if the index trades flat for the week, the leverage fund will lose you money mathematically. It's called volatility drag. Let me first prove it to you in math, then I will show you in charts. So you decided to hedge $100. Monday QQQ went down 2%. You decided to buy SQQQ. So you up 6%. Nice, right? Your $100 now up to 106, as Q's is down to 98. Tuesday, Q's went up 3%, so you are unfortunately down 9% to 96.5, as Q's is at 101. Wednesday, Q's down 4%. Great day for you, as you're up 12%. Now you're up to 108, as Q's is at 97. Thursday, Q's up 2%. You are down 6% to 101. Friday, Q's up 1.2%. You are down 3.6% to $97.9. As Q's is still at $100 on a flat week, you are losing $2 for every $100. Just look at what happened on a 1 week period. The Q's is flat. Use any kind of percentage you want. The triple leveraged is the loser here. This is without any premium added yet. Let's think about this in an extreme way. Think about Black Monday. In 1987, the index moved 20 to 30% in a day. Let's say QQQ went up 33% in a day. Then SQQQ will go down 99% in that day. Then your $100 position will be down to $1 just in that day. If the next day QQQ went down 50%, your $1 position will only up to $2.5. This is how dangerous Leveraged ETF is. Of course, Jeremy didn't tell you that. Here's the reality. We didn't sell when we went sideways for 2 months because the market was well hedged. A lot of that, and we move freely higher now. We're sitting at the 61.8% fib, the same level of the failed 2008 bear market rally, which also turned to a quote, bull market. We have some of the highest technical readings of overbought in literally years, with positioning at extremes, in some cases all-time highs. I understand the logic you want to short this market, for we have record call buying speculation into this well-hedged market structure, and it's rallied as a result, farther than it probably normally would have. But SDOW is not the way. Next week, we will also have CPI, FOMC, the Treasury auctions. It's a big week of data and a very large OPEX. We follow that up with expiration and quarterly OPEX at the end of the month. If you think now is a good time to buy or speculate, I have a bridge to sell you. In fact, history shows this is the absolute worst time with some of the lowest probabilities you can have in your favor. After Friday, that pressure will be reduced gently. Just at any point here, if the selling pressure is greater than that auto bid. We move lower regardless. As much as you'd like to think that we're in a unique situation or that it's different this time, it's not. We saw a similar environment in both the 2021 and 2022 tops. And just like then, small caps rallied at the end. And sentiment readings hit highs. Additionally, it is different this time because we are about to see a liquidity drain as the Treasury finally begins major auctions a day before OPEX. History doesn't always repeat, but it often rhymes. And that rhyme is telling you that we are at or near a major cycle high. Drunken Miller said, "I am so tired of being a bear and being labeled a bear." We always short the same way. I try and think of a situation 12 to 18 months from now, and if I think the security prices are going to be less, I short. Frankly, I'm not sure I've ever made money in shorts. I like it. It's fun, but you can get your head handed to you. When I was at Soros, I shorted $200 million worth of internet stocks in March of '99, and in 3 weeks covered them at a $600 million loss. I lost $600 million on a $200 million investment in 3 weeks. I was short 12 stocks. They all went bankrupt, every one of them. I think my record is as much knowing not when to play as when to play. Because I deal in 5 or 6 different asset classes. If there's uncertainty in equities, usually that's a good time for bonds and currencies. They're doing crazy things when the world is blowing up. This is the most complicated non-roadmap, unanalyzable situation I've ever seen in terms of having a lot of confidence in an economic prediction going forward. I honestly don't see a fat pitch right now. I do think some really fat pitches are going to emerge in the next 8 to 24 months. I don't want to blow my cash and be in a horrible mental state being down on a big bet on something that I didn't have an amazing conviction on. August 10th, reserve balances at Fed banks, $3.348 trillion. August 16th, SPX at 4,325. June 7th, reserve balances at Fed banks, $3.349 trillion. June 9th, SPX, 4,323. Zero net liquidity change, zero change in SPX. If anyone still has any doubt about liquidity driving everything, up or down, all bull or bear narratives are just reflections of price-driven sentiment at any given time. When did everything tech bottom? January 4th. When did reserve balances bottom? Same day. Nearly $500 billion in liquidity added since. That's your rally. Everything else is just narrative to justify it. It's liquidity, and the Fed is driving it. I can even correlate this with individual stocks, such as Tesla as an example. Below is a rough approximation, as I can't scale the dates on both charts precisely, but you get the drift. The stocks, peaks and troughs are directly correlated to the flow of reserve balances as well. In my view, we've seen such an extreme outperformance in a few stocks because that's where most of the liquidity went this time around. The narratives then followed and fed on themselves due to strong recovery creating an aura of invincibility, and then retail started FOMO chasing. Bottom line, to sustain all this, you need even more liquidity. The narratives are almost a distraction, or worse, a deception.
But to get the people that have been in this market 10, 15, 20, 25 years that are bulls, to get them to really shake out of everything is so damn difficult now at this point in time.
Because they become self-fulfilling as a result of the liquidity. It distorts perception as liquidity has amplified the moves. That's why it remains key to keep watching what happens with liquidity going forward. If you don't know when the Fed will increase liquidity, how can you play SDOW or SQQQ at all? Let alone sit there and wait weeks or months like Jeremy.
Realized I'm riding around like a cowboy with no insurance and this isn't good.
Don't throw away your money by listening to Jeremy again. And my client Teddy Eazzy's book, Wicked Pussy Perfume, it is an femdom novel, and it's about money, stockings, and the stock market. Order your copy today. You are such a good boy for watching my video right till the end. Bye.